All right. Thank you for the, to speak here before the finance, committee. I know it's been a while since we last met. Certainly welcome the opportunity to meet more often, but let me give you an idea in terms of what's been going on. You'll see on page 2, or for those who, I think you got the PDF over on your side here. Yeah, okay, good.
Awesome.
But, the market, US, saw a very, the strongest start for US large cap stocks since the pandemic. Stocks up nearly 20% for the first 8 months. September started off with a slight decline. There's been a lot of volatility surrounding the upcoming Fed policy decision, which we'll talk about in a second, this afternoon. Growth has been resilient as consumers have been inflation, which certainly post-pandemic spiked, has now come down quite a bit and is now at a level just below 3% and proceeding towards 2%. Wage growth has been moderating, but we've seen a number of layoffs here that have certainly caused some concern. But overall, consumer and corporate balance sheets have been strong. And as I said, about rate cuts, European banks have cut rates twice earlier this year by 25 and 25, and just about an hour ago, the Fed announced that they were cutting rates by 50 basis points. And that was was it going to be 25? Was it going to be 50? Overall, the feeling, what came out of the minutes was that inflation is certainly well under control. But the concern was on the job side. The Fed has a dual mandate, both inflation and full employment. And certainly with some of the layoffs that were coming recently, the Fed decided to go ahead with, it was somewhat split between 25 and 50 basis points. They decided in the minutes that they would go 50 at this time. And the signal is potentially 2 more rate cuts between now and year end. And they meet both in November and December, and it could be 25 and 25 anticipated here for that time period. Artificial intelligence, as we know, is a real, is a real thing and represents really a new round of transformational technology that we're now just starting to see come through. And U.S. mega cap largest companies are the ones that are really taking the most advantage of it right now. Corporate earnings is forecast to be up this year close to 13%. And equity valuations, as a result, we'll talk about equity valuations. I don't want to get too much into that right now, but overall, we'll talk about long-term or overweight stocks versus bonds. We'll talk about your portfolio. You made I think, a very good move a year ago here when we made the change to the allocations. And certainly it's paid off well for you. The risks looking ahead will be continuing to be inflation, any unexpected bad actions, we're not seeing any at this point, and any over exuberance in the market. So page 3, the question is the soft landing achieved? And certainly one of the concerns of a 50 basis point cut was, does the Fed know something that the market, doesn't realize? We don't think so here, but overall, if we had been looking at this, 6 to 9 months ago, well, last quarter was not forecast to be as strong as it is now. So the market has been surprisingly resilient and a little bit stronger than what's anticipated. I mentioned on page 4, inflation has certainly come down off of its peak, and is now, when you look at it relative to long-term norms, is at low should be. And certainly we're not seeing it at this point bumping up. Unemployment and wages on page 5. Wage growth has moderated quite a bit. That was one of the critical components of inflation and unemployment right now has come down as well. You can see well over 15% here during the pandemic, now down 6.2. As I mentioned on page 6, earnings will continue to be resilient. That's one of the things when we look at the stock market. Stock market prices are based upon future earnings and the growth associated with those earnings. And certainly it is those have been somewhat consistent. I'm going to skip over page 7 and just talk for a second about page 8. We're seeing a spread now, and of course I wish I had it as of now, but what we had here was an inverted yield curve. With the lowering of the rates, we're now seeing that yield curve flattening, and if anything, we might see a little bit of a curve to that, positive trend in that inverted yield curve. The stock market on page 9. From a long-term perspective, and this is, one of the reasons why we invest for the long term. Certainly, there's volatility in the stock market. That's to be expected over the short term, but over the long term. The stock market now is even higher. This was as of the end of August, and we're even right now a little bit higher than this right now. The valuation on page 10. Is somewhat towards the higher side of historically, but it's not a, what we would say, overly high position here. So and a lot can depend upon the future growth in that market and whether, as the market grows, that we call it the price over earnings ratio. If earnings continue to grow, it will support further price increases in the market. And in all fairness, when we look at the valuation, we're talking about a measure called the Standard & Poor's 500. It's the 500 largest companies in the United States. But the one thing it really does tell is the fact that there's a concentration of the 10 largest companies that really account for about 35% of the market capitalization right now. And you can guess what those companies are. Apple, Google, Broadcom, Tesla, Eli Lilly. I mean, these are the largest companies down in the United States. So sometimes when we measure the S&P 500, we kind of throw it all in one basket by taking those 10 largest out of the equation. In fact, the other 490 are not quite as high priced as those 10. So that's something we keep an eye on. The market, in essence, may not be as highly priced looking on a company by company basis as those 10 largest ones. Valuations overall in the United States, again, they're a little bit higher compared to the rest of the world. And that's primarily because the U.S. economy has been stronger than the rest of the world right now. But when we look at your portfolio, we do have U.S. stocks, we do have international stocks, we do have emerging market stocks. That provides diversification overall, and those areas in the rest of the world are a little more in line with their historic norms. So let's take a look at your account, starting on page 13, where we were a year ago. A year ago, we were about a little over 632,000. As of the end of August, you were just shy of 730,000. So nearly $100,000 increase in market value here. Primarily, about a quarter of that was income, the rest of that was in market appreciation. We look on page 14. The allocation on the left is when you were primarily in a fixed income and cash portfolio. Now to a more long-term allocation between stocks and bonds, we call it moderate risk allocation, so that somewhat equally divided between stocks and bonds. And the portfolio's returns down below, total return for the account last year was a little over 15.5% versus the benchmark 14.8. So overall, done very well. Longer term, you're going to see that the returns have trailed the benchmark, and that's primarily because the allocation is pages 15 and 16 are the actual, just the individual holdings themselves, all representing, the categories and headings that we have, and these investments are screened and reviewed by our analysts. They are basically put together, the portfolios put together by our investment committee, they carry out, monitor, and be balanced as needed. So, should stay on the page 17.
That's okay.
That more or less right there is just showing basically had, the investment's been invested for an extended period of time. As you can see, those would have been the returns for the allocation you see right now. So ultimately here, your returns were a little better this year, probably because the timing of we reallocated the investments. It gives you kind of a feeling in here in terms of long term. And, the point of this is long term. So certainly anywhere from say 5 years, 7%, I think would be excellent. 18 is just a disclosure of benchmarks and indexes showing different returns. I think more than that. Is there any questions I can answer at this point?
Would you suggest that we stick with the same sort of investment philosophy and move forward to the next year?
That would be entirely up to how you force, you use the money and what your risk, what your risk tolerance is.
I would say our risk tolerance is no higher than moderate.
Yeah.
Looking around, right?
Well, if you take a look, and maybe that's a good point to look at page 18.
Yeah.
Page 18 shows the different objectives below, the different target allocations, and what those returns have been under an extended period of time.
Mm-hmm.
And, there are different people that have different philosophy, organizations have different philosophies in terms of how they believe money will or will not be used. If you could say highly, with a high degree of probability, there will be little or no use of your funds for a 10-year period, then obviously it pays for you to be more aggressive over the long term. If there's a chance that you might have a need for these funds, and you cannot weather a downturn in the market, then, then they're, being moderate risk kind of cuts right down, right down the middle. I would just say, and I've dealt with some organizations who are somewhat risk averse. And I say choosing risk is very, the right degree of risk is important because people can be too conservative and then realize that if they had invested, more aggressively for the longer term, the extra 1 or 2% might not sound like a lot, but compounded over 10 years can be significant. So totally up to you and that should be an ongoing discussion of your finance committee.
Mhm.
Does feel like the question on how aggressive we want to be, like there's this separate discussion on, well, what do we want to use the money for and what is its purpose? And so we need to have that discussion more. I guess one thing I'm interested in is so the current makeup of the investment, as we think about it, what is your consideration on how it's currently invested today? Like, would you consider it a moderately invested portfolio? I mean, it has a fair amount not in the stock market, and so I assume it's more moderate, although bonds have been higher returns. So just what's the thinking?
Yeah, it is. It is a moderate risk portfolio. Some people call it balanced portfolio. So it equally takes into consideration both growth and income in the portfolio. So it would be certainly suitable, probably for a portfolio that you want some growth, but there is some need for income. If, on the other hand, you don't anticipate drawing regular income out of the portfolio, you may want to consider moving up a step to moderately high risk return to put a little more emphasis on growth. But that's totally your call on that. Or if there's an identified need for any of the funds, having a moderate or a moderately low risk portfolio is suitable because then you can kind of segment whatever you're going to be, you say, I'm definitely going to need $50,000 set aside for some specific need, then go ahead and identify it, match that up. But if there is nothing in the pipeline and no need and no income to be there, you may want to say, even if the market goes down a little bit, I can weather kind of those ups and downs, as evidenced here by the long-term returns market. The other thing people need to account for is inflation. And obviously, the fact that the portfolio grows allows it to stay further ahead of inflationary pressures as well. So all things to consider. You made a big step last year, going from fixed income to having an equity portfolio.
Right.
And the portfolio's done very well this year. There are no regrets on that, but I would suggest looking further ahead. And you probably do have, as a lot of boards do, have a long-term plan you put together. You may want to coordinate any goals with these funds with that long-term goal and then allocate it appropriately.
And given where we are today, do you have a sense for what would you consider a safe withdrawal rate that we could sort of plan around, I guess, given what we're invested now, or if you have a recommendation, what should we be thinking about relative to withdrawal rate?
Withdrawal, we call it a spending policy that you would use, and generally, a spending policy based upon a perpetual, that you perpetually keep the endowment in place, and obviously maybe even offer a little growth. Might look like this. It might be a moderately high risk return. So it might be about 70% stocks, 30% fixed income and cash. And then utilize a withdrawal rate of 4% of a 3-year market average. And when I say market average, I mean that takes into account any changes in the market
Right.
with the portfolio, so that you're not necessarily just pulling money out at a percentage that would be at the high.
And that's about $30,000 based on 730,000 that we have invested currently. Yeah,
So that
which
would be we would recommend if the wish is to keep that going perpetually. Because I mean, if you take a look at the long-term returns of the portfolio, you know, I would say at higher, well, you take a look at the moderately high risk return here. You can look here at the 10-year return at about 7% annualized.
Mhm.
So you're
Yep.
taking 4% out. You're paying fees of about, you're paying less than 1%, but let's just say all in expenses, let's say 1%. And that still leaves about 2% growth.
And since I've been on the board, I'm not sure that we've ever had a discussion on what's the consistent, you know, do we have $30,000 to fund things? I'm not sure if we've said that specifically. And so I think it's useful for us to be thoughtful around, like, that could be a ton of money and just be like, that's not nearly enough for all that we want to do. So I think it's useful at least to have a start there to say, you know, that given where we are today, that's a safe place that we could bank on. And if we wanted to do more, then there are things that we can do, either more aggressive investing or fundraising. But at the very least, we have a safe, you know, we're in a pretty good shape if we want to keep things kind of essentially where they're at with the endowment today, to say we can fund, you know, around this much sort of on a perpetual basis. Is that fair?
Yeah. That is.
So this is only the endowment and not all of our.
Correct.
Okay, just want to check the wording.
Yeah.
Right. And so that means that we could also consider on the other funds if there's other stuff that we want to be doing there with them.
Yeah, I think with the strategic plan, which hopefully will be finalized for the end of the year, we'll have a better idea of, how much we might want to use year over year. Or range
100%. Yeah.
use year over year in terms of real dollars. And that would make it better for board and staff in terms of understanding what's available.
Yeah, it fits so well with all the things that we've talked about in terms of better communication with staff, understanding on how to use the dollars. We're going to have a new executive director. And so it'd be pretty great to be able to say, you know, hey, there's money that we can be thoughtful around, all those kind of things. And so yeah, I think it's great to be able to think through that. Awesome.
So would it be helpful perhaps maybe if I came back sometime in the first quarter here and we could talk about this a little more in terms of once you had this discussion?
Definitely after election and after.
Yeah.
Yeah. Yeah, so maybe the January, February.
Yeah.
What are you seeing from other similar organizations like ours in terms of their appetite for risk? And I mean, we're different than other nonprofits, but I'm not sure how exposed you are to others. And so I'm just interested in how they're operating.
More often than not, you will see probably long-term money invested in a moderately high risk return portfolio. But I had one organization the other day, they just finished their capital campaign, they just built, they had money left over. And their attitude is, we have nothing at all we need these funds for, and they put everything in the maximum. They put the most aggressive portfolio because they said, look, we know we're not gonna have any needs for more than 10 years. So we can absorb ups and downs in the market. And
Lucky that.
yeah, well, it was fortunate, but I understand that's unusual. That's unusual because most boards do not want to get as aggressive as they did, but I understood where they were coming. I think more often than not, sometimes I'm dealing with a board that has a lot of money invested in short-term instruments, or, you know, they've got too much money, they're holding in the bank, you know, they're not earning very much on it, and, you know, they're losing the opportunity there. They look at what you all experienced last year.
Well, you probably, you don't know the history, but some of this money is over 100 years old.
Oh, I know. We've got,
So we haven't been big spenders.
yeah,
There's also concern that we're a public entity, we don't displace public funds by paying for things that should otherwise be publicly paid for. So money that is accumulated, it accumulated really with the sale of the nominal assets donated.
so I think, you know, part of what you were doing as a board, which is prudent, is you're basically, you're working with us, which is, we're operating the fiduciary capacity. And you all, what we're doing is we're gonna set the parameters and guidelines. And as you said, the goals of the funds. And quite frankly, as long as as the decision-making is sound and logical and, you know, focused in an approved manner, the board certainly can't be held at fault. What you're doing is no different than what any other you know, if you look at the, let's say, any of the community, you know, some of your community foundation, for example, they manage their funds much the same.
Are there any rules around withdrawal with you all? Like, are in terms of policy for why or why not we withdraw funds from the?
No, we're acting as your investment manager, and the only, you set the parameters through your corporate resolution as to how they're, and I don't have that in front of me, but, whether it requires, you know, one or two authorizations, so forth. And obviously, we take a lot of steps to make sure that that's done, you know, correctly and safely.
And then in terms of how the dollars are invested today, you talked a little bit around, you know, where most valuable companies are. We're invested in sort of a broad stock that's tracking the most valuable 500 companies. That's great. Is there the case that you all would shift how it is invested sort of on your own as you're tracking things? Is that a thing that you check in with us first on? Is that a thing that we say, this isn't the fund that we want to be invested in? Like, how does that operate? And what's your responsibility as the investment manager there?
Responsibility is we put together the allocation, we choose the investments themselves. We work just, you know, we work with outside advisors. We work very closely with the Northern Trust Company out of Chicago, which is the world's largest investment advisors. And we put together a policy for you as we're investing that we use for many of our fiduciary, you know, accounts. At this point, we manage over $9 billion here in over 6,000 accounts.
I think once we conclude our strategic plan or get closer to that finish line, then I think we'd be in a position to determine what that spending rate is and sort of talk about, because our hope with the funds is we would like to set aside a certain amount each year to be able to use and fund, you know, employee sort of initiated projects. Right? I would say that's an accurate description of what we're talking about. So I think we're looking to see, and that's why Sam asked, is we're looking to see like, what is that amount that we want to consider funding per year? What does that look like? It's not, It's not the way traditionally the funds were utilized in previous boards, but it is.
And if you'd like, we have, might be helpful, I could send you a sample investment policy with investment / spending policy. And it's certainly something you could change as you would see fit, but it might give you a starting point as to how you might want to break.
Sure, that would be great.
Yeah, I think that'd be helpful. Yeah, my sense is I don't have much desire to like just have the fund grow to grow. It doesn't make a ton of sense to me there. I think it's there to fund and support programs that the system needs or wants to try, and that's part of what we're here for. And so that's what my priority would be. Obviously, we want to be responsible with it, and we don't want to over withdraw, but that's where I'd like to go. The other thing I think, to Ed, your point, I think we want to be careful about how we talk about it and how we're prioritizing, because we don't want it to be misinterpreted that we've got this whole, bank of cash that absolutely large. It's also not that big if you consider the global budget for the system, but what its purpose is, because what we certainly don't want is for, people to say, oh, this is for operational use and we can cut your budget by $1 million because you got $1 million sitting there. At the same time, we want to be able to support the programs that the staff wants to pilot and attempt and help to improve the community. And so finding that balance, I think just also realistically, I think we want to continue to support the mission that we believe in as a library. And so to the degree that we can say, this money is here to do this kind of thing, even if it isn't, fully restricted, I think it is worth us thinking about what are the kind of controls that we can put in place to say, we aren't going to fund a program that talks about book banning. That's just not going to be a thing that this money would be used for, but it will be used for other things. And so, that may not be something that you all could control, but I think it is worth us thinking about how that happens, because it is a lot of money, and and ideally it's going to the right things that at least we consider today.
Sam, the interesting thing about that is once we understand our spending plan, we can go to focal.
Yeah, exactly.
And say, this is our spending plan, and will you hit your spending, your donations to this plan, or you create a spending plan for how you want your focal donations spent and grow, and whatever the right words are.
Absolutely. No, I agree completely. Right. And we could match things, whatever it is.
Yeah, I was thinking that we would ask them for a match
Yep.
towards our plans, because that match seems to me to be an attainable amount. For them.
Although they are currently giving us less than that. So yeah, I think it would be a goal.
It's true, but I think in terms of the goal, I think it's something to work, because I think that allows us to have the most impact, and allows them to also have some sort of conscious definition of what the funds are going to be used for, right? Which I think is their other. So I think that's a conversation.
Yeah.
And you were stating earlier a little bit of the history of where these funds came from. That might be useful to just have a brief description in the beginning of the investment policy for that reason, that those who aren't familiar with and understand these funds did not come from public monies.
Right.
That they came from outside donations with the purpose of supporting the library, but not necessarily the daily operations here. I remember in my own case as a former library director that when we moved from a free library to a special legislative district, we took care to separate those endowment funds, put them aside, because once we became a special legislative district, we were asked, well, how come these funds are being used to reduce people's taxes? That was the purpose for how this was.
Yeah, and put together an editorial documentation that we can actually include in our spending policy as well. just to give that historical piece,
Yeah,
especially for
and
future
and
board.
maybe some of those funds, maybe there was something in there where they said, we want to use for some specific or some general.
Mhm. We do have a couple things that are earmarked for a particular thing, we're working on that, but, and they're included in this money, so
Thank you, this is great.
Sure,
that's very helpful.
and I'll
One more,
follow up and send the sample policy to you, Christina, and then perhaps we can, get back together, after the first of the year and share with you basically the results, and we can talk a little bit more about this.
I think that'll be helpful. So how about Sam, I copy you on the email back. So I am terming off the board in December.
Oh.
So, I will be replaced. If you want me, I'm still around, I'm happy to help,
Not gonna let you go.
to some degree, but, so I'll include Sam,
Okay.
as board president so that you have that, connection.
All right. Sounds
and then
good.
one other thing that would be great just to get, I think, is just an overview on just what the like how you all are being paid for it. So what's like how is that calculated? Is it based on value of the portfolio, those kind of things? And just what it'd just be useful to understand what that looks like, so that as we're thinking about, you know, how we want to be investing and all of those different things, it just helps to paint the full picture.
Yeah, it's a percentage of the market value. I believe I have to take a look, I believe it's 80 basis point, 0.8%. And it's just taken out on a monthly basis, but the 0.8% is the annualized, you know, rate, so to speak here.
Got it.
And I
Okay,
think
that sounds good.
Excuse me?
It is, the fees were,
Yeah, the fees.
we're on page.
Yeah, oh,
Yeah. Back on our breakout, which I think is the page before this one, I think it's 13, but I can't get my page.
yeah, if you look on, yeah, I should say
Yeah,
page 13, yeah, the fees
About 2,600.
for the last 12 months,
Yeah,
yeah, all based on market by the 2,677.
Yep, perfect.
All right,
Great,
great.
thank you.
Thank you.
Thank you.
So nice.
Thanks so much.
They don't do business.
I think we do, I think we do not have other business. I know Sam wanted to raise, one item, right, Sam?
Yeah, I think just something to talk through. I think again, as we go through the strategic plan, interested, Heidi had recommended a financial advisor that may be worth speaking to. And then also my wife had on a different board, they'd had conversations with the community foundation in terms of managing funds. And I'm interested in just running the paces on that to understand what they have to offer, how that can be good for us potentially, where it may not be good for us. But I think if we want to be thinking about how we are strategically managing our dollars, again, Ed, to your concern around the county thinking about what endowment looks like for us and where they might be able to take advantage of it, the community foundation potentially offers some protections there where we can set some guidelines on exactly how the dollars can be spent and could ensure that it's not spent for operational uses. And so I think it's something that's just worth doing as we start to plan for how we might use these funds. So that's something I'm happy to take on just to set up some of those discussions. If everybody's comfortable, would love to have other thoughts and partnership there. But I think that's something I'd like to be able to do.
so would the goal be then to turn the money over to the community foundation? Or just to understand how they invest so that we might on our own do something similar?
Well, I mean, I think I'd want to understand what the program is and what they offer. And then potentially, if we said that's a pretty good deal and it makes sense, then
Sam, you're frozen. Hopefully you can hear us, but so Sam had asked me if we were comfortable talking about it in this room, and I think we certainly are. But the Community Foundation offers some alternatives where you can make a contribution to the Community Foundation. They set up a fund for the benefit of the library. We would then be subject to a request process through their board. So it is something to fully understand before you take it over. I did mention to Sam that it's not something I would feel comfortable voting in favor of, only because I'm about to leave the board. So I think it would be a decision into the future. Does that make sense? So what they do is they actually manage the funds for you. So, Sam, I'm just explaining what the process is that you and I talked
Yeah.
about. So
Yep.
they manage the funds for you, and then as I currently understand it, you have to request approval from their board to release the funds. They do not, I have several clients that use them to administer and oversee their funds. I'm not aware that they've ever denied any request, but it's someone else to sort of track those funds and provide you a regular statement on a monthly basis.
So they become like a fiscal partner.
But they rely.
Sort of.
They rely on fiscal advisors, just like we,
Right.
so it's another layer,
They,
you know, but yeah, bear in mind, you're gonna lose the confidentiality when you do that.
Yeah, I'm not convinced that that's a thing that like,
You're not gonna.
Right.
I don't think you're gonna keep it private.
They shouldn't be private.
Well, that's one.
yeah,
of the
I'm not sure that that's a.
Hmm?
I think what I'm asking is, does anyone have an issue if we find out more information about it? I think I'm not asking, do we want to move all funding to the Community Foundation today? I think it's let's find out some of the answers and some of the considerations.
if you were to ask, I would suggest like not giving these specifics, just say,
Yeah, just informational.
what your process is for administering or overseeing another nonprofit's funds, right?
Yep.
So this is the way that my other clients have it structured is the way that I've described it. And it gets recorded on, as I understand, it gets recorded as an asset on the entity's books. And then it's like funds held on behalf of the organization, right? So they're not funds held in our name in the way that these funds are held in our name. They're held by another entity. But it's not a true agency fund like some organizations have. We would actually make a contribution to the Community Foundation. It would be their funds to distribute on our behalf. So I think that's the piece of understanding that people have to be really clear about, unless that policy has changed or they're doing it differently. I understand that not-for-profit laws only allow them to have a certain number of agency funds, and I do not believe this would be an agency fund.
Okay. Yeah, I mean, I think I'd like to just learn a little bit more. The other benefit too is I think that they have a way to donate to the specific funds that are established. And so it sets up a place where, then we can say, you want to make a contribution, like go through the Community Foundation. We've got a page there you can donate, which is, I think, a little bit more straightforward than the way that it happens today. And so, and we can also then set up better gifting policies about what we will accept, what we won't accept. Could even potentially, as we've talked about with different branches, like maybe we split out some of the funds so that the different branches have specific funds there. I don't know. Again, I'm not like proposing a specific thing. It's more that as we've talked through some of this, I think there are gaps in how we're understanding where we can use and take advantage of the funds that are available. And so I'd like to be able to figure that out more, because I think it sets us up really well coming out of the strategic plan to be more sort of aggressive in how we're supporting some of the things that we really want to get done. And maybe it's all good and we can do it the same way as we're doing it today and we're in good shape, but not totally convinced of that. So I'd like to get a little bit more information on that.
Sam, I also would like more information, but I think some of the things that you've just mentioned in terms of accepting donations are where we should be looking at focal, because they took over the foundation, so they should be how we are receiving donations. So I
Again,
just, that we need to
Yeah.
like push on focal, in terms of a MOU, in terms of process with them. And we've got people coming in, so we probably should.
Okay.
Maybe before community foundation or at the same time with the community foundation.
Yeah, agree. I mean, my hope is that we could do all of that before end of year. Have that conversation with,
Please stop.
have those conversations.
No, come on, you're okay. So I think we'll have a follow-up meeting, which I think we had hoped to do another follow-up meeting in, the either October or November timeframe, after I'm able to make those QuickBooks, items with Mark. So how about, we table this and we sort of connect over email and set a date for another meeting? Does that sound okay?
Yeah.
And we'll check with Tim too, because I'd want to talk to him as well.
Yeah.
Sound good?
Sounds good.
Thank you.
Thank you. Thanks, Christina.
Yeah, I will say this out loud now, and I'll say it in the email later. I will not be at the October meeting.
Okay, so we will not set the meeting to be the day of the October meeting then. Okay, where are you going?
Saratoga Springs is probably her cousin.
Oh. Nice. Good for you.